The Dow Jones Industrial Average surged 646.26 points today. I mean, that's a robust 1.34% gain, closing at a record high of 48,704.01.
That headline is pure celebration. It really is. But for anyone who spent, 5 minutes in the market today, they know that's only half the story.
Right.
The real theme was just a striking market divergence. While the Dow hit that record, the tech-heavy Nasdaq composite actually dropped. It fell 0.25% to 23,593.85.
So you have one major index at an all-time high while the other is in the red.
Exactly. That massive difference signals a huge, aggressive rotation of capital, and it's being driven by some very serious sector-specific fears in technology. And this is all happening just one day after the Fed's latest rate decision.
That paradox is really what defines the whole session. So our mission today is to unpack this rotation. Where did the money flow, and why did the tech titans stumble so hard? And we also need to understand the reverberations of the Fed's policy, because the signals we're getting from bonds and commodities, they're mixed, almost contradictory.
This was easily one of the most challenging sessions in months to interpret. You've got these simultaneous messages of intense fear and, on the other hand, immense confidence, just playing out across different market segments.
A puzzle.
A fascinating one, though.
Okay, let's unpack this. The clearest sign of that rotation you mentioned is in market breadth, just how many stocks were actually participating.
Right.
What really stands out is that aggressive move away from the mega-cap tech names and into, well, smaller, more economically sensitive companies.
Right.
How dramatic was this shift?
It was one of the widest daily divergences we've seen in quite some time, and it tells you everything about where investors want to put new money right now. If you look at the benchmark for domestic economic activity, the Russell 2000, which is all small caps, it just exploded. It jumped 1.21% to 2,590.61.
That outperformance is just stunning. The S&P 500, which is supposed to be the market's proxy, only managed a 0.21% gain?
Right.
So small caps outperform the broader market by a full percentage point. When does that even happen?
It happens when money is convinced that a soft landing is coming and that we are, firmly out of the woods on recession risk. That 1% spread is massive. And it signals investors moving decisively towards cyclicals, the kind of companies that directly benefit from strong domestic growth and easier financial conditions. They're betting on the real economy.
So if tech was the source of funds, we need to follow that money trail. Where did that capital actually go? Let's talk sector leadership.
The destination was cyclicals, period. Materials led all sectors with a powerful 1.99% gain, closing at $45.12.
Okay.
Right behind them, you had financials up 1.82% to $54.87, and then industrials, which posted a 1.07% gain.
So these are the sectors that need economic momentum. They're like the scaffolding, the physical economy.
That's a great way to put it. And the opposite side of that trade, of course, was technology, the obvious casualty. In stark contrast, technology was the major laggard today, falling 0.51% to $147.97. So if you look at the best performing sector, materials, and the worst, technology, you've got a 250 basis point spread. That is a clear sign the market is trying to broaden out.
I also noticed financials got a little extra juice today, something entirely sector-specific.
They did, yeah. They benefited from news that Treasury Secretary Bessent proposed shifting the Financial Stability Oversight Council toward looser regulation.
And for banks, that's not just bureaucratic noise.
Not at all. It's a concrete catalyst. It makes them look much more attractive as a cyclical play. So you're right, they got a boost from both the macro picture and this very specific regulatory news.
Okay, so let's zero in on that tech fear. If the rest of the market was celebrating, what was the single thing that caused technology to recoil so hard?
It was entirely driven by one company's report.
Oracle.
Oracle, the company plunged approximately 13%. They missed on expected revenue reporting, $16.06 billion versus the $16.21 billion expected. But honestly, the revenue miss wasn't even the scary part.
So what was it?
It was their capital expenditure projections. The CapEx figures for the AI build-out.
Ah, the famous AI CapEx story that's been driving the entire sector.
Precisely. Oracle projected $50 billion in 2026 capital expenditures.
$50 billion?
And that is a stunning $15 billion more than what everyone anticipated. That $15 billion surprise, I mean, to put that in context, that's like the annual defense budget of a mid-sized country.
So the market is looking at that and asking if the huge margins in AI are sustainable if the cost to play is just skyrocketing this fast.
Exactly. And that fear is palpable. It makes total sense why the Nasdaq dropped. But here is the central contradiction of the day.
Right.
When you look away from that one stock and look at the market's fear gauge, the VIX, it tells a completely different story. We have massive corporate fear, but market volatility collapsed.
How does that work?
It's a key signal that the market views this tech pain as, well, as idiosyncratic. It's specific to Oracle and this AI CapEx issue, not contagious to the whole system. The VIX plunged 5.83% to 14.85.
That's a big move.
A huge move. It's post-FOMC relief. It signals confidence that the Fed has kind of put a dovish floor under the market.
And if you look at the shorter-term fear gauge, the relief is even more dramatic.
It is. The 9-day VIX, which tracks immediate volatility, cratered 15.12% to 12.46. And the market structure is still incredibly calm. We call it contango, right?
When near-term volatility is lower than future volatility.
Exactly. And the VX3M VIX spread is sitting at a wide 4.20 points. So the market is basically betting today will be calmer than 3 months from now. They're paying a premium for insurance against future problems, but pricing out immediate risk.
That helps connect the dots. Okay, let's talk about the Fed. They delivered the third rate cut of 2025, bringing the federal funds target to 3.5 to 3.75%. But bond yields fell. Why?
This is a really important question. It seems the bond market is focusing on two opposing things at once.
Okay.
They like the immediate dovish cut, obviously, but they also absorbed the hawkish surprise in the dot plot, which signaled only one additional cut in 2026.
So the bond market is saying, thanks for the cut, but we're still worried you'll be too slow next year.
Precisely. So bond investors pushed yields lower anyway, signaling some lingering concern about maybe economic deceleration. The 5-year Treasury led the decline, falling 5 basis points to 3.710%.
So we have stocks and bonds both rallying on the same day, stocks celebrating growth, bonds rallying on slightly lower yields. This is the definition of Goldilocks, isn't it?
That's the narrative the data supports today.
Yeah.
The benchmark 10-year yield settled at 4.140%, down 2 basis points. But the most critical piece here is the yield curve itself. The 10-year minus 3-month spread is sitting at a healthy positive 57 basis points.
A huge contrast to the inversions we saw in previous years, which are classic recession signals.
Right. When the curve is sloped like this, it's a sign that the plumbing of the financial system is working and anticipates normal growth.
So did this easing immediately translate to consumer relief, say, in housing?
Not yet. That transmission takes time. The data shows the 30-year fixed mortgage rate actually edged higher to 6.22% from 6.19% last week.
So long-term inflation concerns are still there, keeping mortgage rates sticky?
That's right.
Okay, let's widen the lens. How did all of this affect the dollar and global assets?
The DXY, the dollar index, felt the pressure hard. It fell 0.47% to 98.33. That's its lowest level since late October.
And why the drop?
It's mostly speculators unwinding their large net long dollar positions. They're betting that with the Fed cutting, the dollar's strength is temporarily over. And this dollar weakness was the key for commodity markets. But it caused a massive split, a real bifurcation.
Okay, tell us about that split. I saw some absolutely huge moves in metals today.
Precious and base metals just surged on that weaker dollar. Silver was the outperformer with a 2.76% gain to $63.57.
And copper?
Copper surged an incredible 3.99% to $5.49.
And the driver there was China's stimulus hopes.
Exactly. Copper is so leveraged to industrial output in Asia. But on the other hand, the energy sector, which usually likes a weaker dollar, it crumbled.
Why?
Fundamental oversupply concerns just overwhelmed the currency tailwind. Natural gas had the steepest decline, collapsing 7.99% to $4.23 on warmer weather forecasts.
A pure supply and demand story.
Completely. And WTI crude also declined, down 0.96% to $57.90. So you have copper celebrating global stimulus and natural gas collapsing on weather.
A perfect summary of the day's complexity. Now back to the domestic economy. We saw a key employment signal today.
We did, and the signals were mixed. Initial jobless claims, they jumped unexpectedly to 236,000 for the week ended December 6th. That was above the 223,000 estimate.
Which would normally be a red flag.
It would. However, continuing claims fell sharply by 99,000 to 1.84 million. well below estimates.
So the market is reading the initial claim spike is just Thanksgiving-related noise, not a real crack in the labor market.
That's the consensus interpretation. The drop in continuing claims suggests that people who are unemployed are finding new jobs pretty quickly. It supports that soft landing argument.
We can't ignore digital assets. Even with tech under pressure, Bitcoin saw a strong rebound late in the day.
It did. It really positioned itself as a high beta risk asset that benefited from the overall post-FOMC relief. Bitcoin rebounded 2.60% in the final hour to $93,423.
Reclaiming that $90,000 support level.
Reclaiming that support, yes. But it's important to remember, even with today's move, its 30-day return is still negative at minus 9.41%.
Looking ahead, the immediate focus is testing this AI narrative that Oracle just shattered. We have a major catalyst coming right after the close.
Absolutely. The immediate focus shifts to Broadcom earnings. That report will be the first real test of whether Oracle's spending forecast is, a one-off, or if it signals a broader systemic AI infrastructure worry.
And beyond that, what economic data do we need to watch next week to validate this whole soft landing thesis?
We need concrete validation. We're watching retail sales on Tuesday, industrial production on Wednesday, and then housing starts on Thursday. Those three reports will either confirm or deny the market's current Goldilocks positioning.
The market really delivered a decisive rotation trade today. Record highs in the Dow, masking a fundamental reassessment of tech leadership.
That 1% small cap outperformance combined with the sharp VIX collapse. It signals a major shift in risk-on sentiment, which is why the key question today is whether this represents healthy market broadening, which would be constructive, or if Oracle's warning is the start of a more serious tech correction that eventually drags everything else down with it.
That's the big question. Well, that covers today's incredibly complex price action. This was a challenging but fascinating session.
We've discussed a lot of movements, correlations, and catalysts today. That's the daily consolidation. And as always, remember this analysis is informational and educational only. It should not be taken as financial advice.
Please do your own research before making any investment decisions. And if you found these insights helpful, make sure to subscribe and like. We're here every trading day right after the close.
Until next time.